Welcome to Capital Link's company presentation series.
Good day to everyone. I am Nicholas Bornozis, President of Capital Link, and I would like to welcome you to the 2024 Capital Link's corporate presentation series. In this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We have with us today the senior management of D'Amico International Shipping. We have with us the Chief Financial Officer of the company, Mr. Carlos Balestra di Mottola. D'Amico International Shipping is a major global product tanker company controlling a fleet of 36 versatile, high-quality product tankers. The company shares are listed on the Milan Stock Exchange under the symbol DIS and also trade on the OTCQX market under the ticker symbol DMCOF. Now, in terms of logistics, we will begin with a company presentation followed by Q&A. Please note that participants can submit your questions through the Q&A button at the bottom of your screen anytime during the webinar, and Carlos is going to address them after his presentation. Or you can email your questions to webinars@capitallink.com. Now, before we begin the presentation, just a reminder that today's presentation is strictly for informational and educational purposes and should not be relied upon. This webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind. And of course, Capital Link bears no responsibility for the content. And in terms of disclosure, we work with D'Amico International Shipping on investor relations. And now I will turn the floor over to Carlos. Carlos, thank you for being with us. The floor is yours.
Thank you, Nicholas, and good morning to everyone. I'll quickly go through the presentation here. It's an update of our 9 months results presentation. I will skip the executive summary. So I'll start with this slide here, where we have we can look at our fleet at a quick glance. We control 36 vessels, mostly MRs, 24 out of these 36, and equal number of LR1s and handy vessels. We have a young fleet, average age of 8.5 years, as at the 31st of December. Mostly IMO class and mostly eco-design vessels, 79% of our owned and bareboat vessels and 78% of the entire fleet. The reason we have such a modern and as Nicholas was mentioning, versatile fleet is because we invested significantly over the last few years, ordering vessels starting in 2012 that were delivered to us between 14 and 19. Here we show the capex relating to this new building program, which entailed investments of over $900 million. And most recently, we have also been busy exercising options on TC in vessels, and we see here, for example, in 22 we exercised one vessel which we had on time charter in, and the price of the option was substantially below the vessel's value at the time. We paid $30 million. The vessel was worth around $40. It has since traded up. We exercised a similar option for a sister vessel this year, paying about the same price. We also last year acquired the shares from our JV partner, the Glencore Group, in Glenda International Shipping. They own 50% of the company. The implied valuations of the vessels acquired turned out to be very attractive, since vessel values rose significantly after the transaction was closed. We have now mostly maintenance capex left and not significant numbers for 24 and 25. We don't have any new buildings on order currently. But I will touch upon our capital allocation priorities later on in the presentation. Here we show our debt repayments, which have been coming down on a daily basis as we have been deleveraging our balance sheet. We don't have any balloons to refinance before the end of 2026. Here we see the vessels that we have on bareboat charter in. We had 9 of these vessels on bareboat charter in with purchase options and obligations. One, which was an older vessel, the high priority we acquired and we sold. The remaining we acquired and we kept them debt free, and we have 3 left. Only we plan to exercise one of these options this year, the one for the High Discovery and the one for the High Fidelity we plan to exercise next year, and also for the Cielo di Houston we plan to exercise in 25. Exercising these options will entail investments of around $60 million. And instead, or rather, debt reimbursements of $60 million. Here, instead, we have the vessels which we have on time charter in, on which we have purchase options and not purchase obligations. We had 6 of these. 2, as I just mentioned, were already exercised, and there are 4 that can still be exercised, and that we will most likely be exercising. Some of them already this year, most likely, and the remainder possibly next year or the year after that. They're all well in the money, and they are also all very good vessels that were built either at Minami Nippon or JMU, which are 2 very good shipyards in Japan. And so we look forward to adding these vessels to our own fleet in the near future. Here we see our contract coverage, which has risen slightly for 2024. It's still at a reasonably low level. We used to aim to a contract coverage between 40 and 60% over the next 12 months. We are now at 31% for 2024 at an average rate of just over 27,000. There is a lot of interest to take other vessels on time charter from us at very attractive levels. We will carefully evaluate whether to pursue these opportunities since we are very confident about the outlook for the spot market. So we are happy to keep a higher portion than usual of our fleet exposed to the spot market. Here we look at our results, potential results for 23, 24, and 25, given different assumptions for the average earnings on the free days, the days that still haven't been fixed, either through spot voyages or through time charters. Assuming we were to earn $25,000 per day on our remaining free days, our bottom line for 2023 would be of around $193 million profit, and in 24 of $125 million profits. We haven't here in this slide updated our spot fixtures relative to what we had presented for our 9 months results, but we did update our time charter coverage. So both for 2023 and 2024, and to a small extent 2025, the figures you see here take into account the contracts which were time charter contracts which were signed since we approved our 9 months results. Going on to the following page, we see our the dynamics for our G&A and OPEX. Not surprisingly, we saw some upward pressure this year for both cost items. We are seeing, however, some moderation now, and actually our daily some moderation in these increases, and our daily OPEX cost for the 9 months 23 was below our daily costs for the 6 months of 23. And this is a trend that we now expect going forward, where future increases in these costs will be much less important than what we experienced this year. In terms of balance sheet, we have a much stronger balance sheet than we used to have a few years ago. At the end of 2018 rather, the ratio between the net financial position and fleet market value for us was at 73%. We are now down to 21. We were down as of 30th of September to 21.5%. We expect this ratio to have improved further by the 31st of December, but we don't have, of course, the figures yet as at that date. So the leveraging, which for us was a key priority over the last few years, is still important, but it's not as important as it was before. We are now also looking to reward more our shareholders through cash distributions. In terms of results, there's not much new here to report. I mean, our 9-month profits were $149 million, and that was a record for us. And we did very well on operating our vessels on the spot market with an average for the first 9 months, which across all vessel sizes, which was above $33,000 per day. The market continues very strong, volatile but strong. December was very strong, especially in the Atlantic, a bit less so in Asia, but the averages nonetheless were good. And we are seeing that vessel values continue creeping up, but they are still below where they were in the last super cycle. In particular, 5-year-old vessels are around 19% below levels reached in the last super cycle, which was from 2003 to 2008, so a long time ago. So on an inflation-adjusted basis, we are much. This difference is even more important, much more important. 10-year-old vessels are 24% below where they were in the last super cycle. That, despite the fact that freight levels, however, are instead at a much more similar level to where they were in the last super cycle. I would say they are below today the peaks reached in the last super cycle, but above the average reached in the last super cycle. And we have had peaks in this cycle which were higher than we had in the last super cycle. So there's room for vessel values to continue moving up. Of course, we have discussed several times already. The war in Ukraine had a huge impact in the market because of how it affected Russian product exports. So Russia is an important exporter of refined products, in 2023, it exported on average 2.6 million barrels per day, which was only 5% below its average daily exports in 2021. But the exports went, of course, to very different locations to where they used to be exported before the war started, where most of the exports used to be directed to the EU. And now, however, they are instead going mostly to Asia, China and India in particular, but also Turkey is an important importer, and we are seeing also the Middle East and Africa have emerged as important importer of Russian products. Europe instead is sourcing a lot of its refined products now from the Middle East and from the US, where these products are sailing much longer distances. Despite the important OPEC cuts that were announced last year, oil supply is expected to increase by 1.2 million barrels per day, 1.3 million barrels per day in 2024, with most of this increase, around 45% coming from the USA, but also the Brazil being an important contributor. The good thing about this additional supply coming from the US and from the Brazil is that a lot of it is going to be exported over very long distances to China, and it will therefore help in particular the crude tanker sector, but indirectly that will also benefit the product tanker sector. On the oil demand front, after very strong growth in oil demand in 2023 of 2.3 million barrels per day, in 2024 we are going to see a further increase in oil demand. Of latest estimates by the International Energy Agency point to an increase of 1.1 million barrels per day in 2024, which is still significant. Especially because that occurs in a market which is already very tight and where the supply of tonnage is going to increase, in the supply of tonnage is going to be very limited. So creating the potential for an even tighter market going forward. In terms of refining throughputs, we are also expecting to see an increase of around 880,000 barrels per day in 2024. Inventories, they are low despite having risen recently, and now they are more aligned with the 5-year averages. But nonetheless, I would say still quite low, given of course consumption has been rising. Here we see instead the refining margins, which have been quite volatile. Currently, the products which have the more attractive margins are the diesel and jet fuel, whilst refining margins for gasoline have dropped since the middle of last year. But overall, I would say refining margins are healthy and creating a strong incentive for refineries to continue increasing refined volumes. What are going to be the drivers of the refined product demand next year? Well, it's going to change quite dramatically from what we have seen in the last few years, where a lot of the increase was linked to the recovery in air travel and therefore jet fuel demand, and in particular linked to the reopening of the Chinese economy, where we saw last year an increase in jet fuel consumption of around 60%. And there's an anticipated increase in jet fuel consumption for 2024 of almost 10%. Nonetheless, at the global level, jet fuel consumption is expected by the International Energy Agency in its latest estimates to actually fall in 2024. I personally think this is a very conservative estimate, and I gut feeling here, not analysis, expect jet fuel consumption to continue rising next year at a global level, unless we have a deep recession, which affects in a significant way, especially tourism, leisure travel. But the drivers next year are expected to change from jet fuel to naphtha and diesel. Naphtha in particular because of the important increase in petrochemical plants expected in China this year. On the crude tanker fleet, it's here the supply picture looks extremely positive. The order book is at a historical low. It ended at the end of 2023. The ratio of vessels ordered to vessels on the water was of only 3.4%. So that will help crude tankers going forward. Through the LR2 segment in particular, the crude and the product tanker sector segments are linked, and when Aframax vessels perform very well, there's an incentive to dirty up these vessels, these LR2 tankers, tightening the market for the other product tankers. Now, as at December, there were 59% of the LR2s which were trading clean. So there is the good potential for more vessels moving into dirty trades and helping our market. Here we show the change in the refinery landscape. This is a slide we have shown for many years, but this is definitely a factor which contributed to the strong markets we are seeing today. In particular, during COVID, there was an acceleration in the closures of older refineries in Europe, US, and Oceania, which contributed to increasing ton miles, since the new refineries which were being built were in China, the Middle East, and other Asian countries, with these products being transported longer distances. This is a trend we expect to continue in the coming years, and it will be continue contributing to the ton mile demand for our vessels. US oil production, we already touched upon this. It is expected to continue increasing, despite the let's say the plans from especially the listed company to continue distributing a large portion of the cash they are generating. But the productions, the shale oil extraction is becoming more and more efficient, and the oil that they're able to extract per rig is increasing, and that also is contributing to this increase in oil production. Steel prices for demolition continue being strong, driven also by historically high iron ore prices. And we will see that demolition is going to be an important factor going forward for the market. Here we look a bit more in depth into this issue. We see how the fleet has been aging quite fast, and actually this is expected to accelerate in the coming years. So at the end of 2023, we had 42% of the fleet which had more than 15 years, and around 11% which had more than 20 years. But this percentage is the percentage which has more than 20 years expected to reach 16% by the end of 25. So that is a very important figure, and 56% of the fleet is expected to have more than 15 years by the end of 25. And we introduced this new graph in our presentation at the bottom of the slide, where we show the proportion and of the fleet, of the current fleet, that is reaching 25 years of age in the coming years. So 25 years of age is an age where, if the vessel hasn't been already demolished, it's very likely to be demolished. Also for structural reasons, it's very complicated for these vessels to continue trading beyond that age. And we see here that this is expected to increase steadily and quite sharply in the coming years, in particular from 2027 onwards. So this is going to be a very important factor sustaining the market going forward from 2027. And in particular, if you look at what is happening, for example, in 2031, 32, where you have between 7 and 10% of the fleet potentially being demolished in those years, if these vessels were not to be demolished earlier. you can see that based on today's new building capacity, it is very likely that the product tanker fleet is going to be contracting in those years, creating a very tight market. 2024 is a year where deliveries are going to be very limited, lower than they were in 2023, where they were already very low. And therefore, we see here in the slide that the fleet is expected to grow in 2025 by only 1.6%. This is for the segments we operate in, so MR1s, MR2s, and LR1s. Of course, if you include LR2s here, the picture is different, because a lot of the product tankers ordered recently are LR2s. So it doesn't look as rosy, but then it is important to take into account that, as we mentioned previously, these LR2s do move from clean to dirty trades, and the order book for the crude tankers is very, very low at around 3%. So if you look across all tankers, then the fleet growth for the coming years is still very limited, even after the pickup in orders that we saw this year. Here we see that there were quite a lot of product tankers orders. Once again, here we are only looking at MR1s, MR2s, and LR1s, so 129 vessels ordered this year, bringing the ratio of the vessels ordered to the vessels on the water to 8%, which is still low by historical standards, especially in the context of the aging fleet that we saw in the last few slides. So here instead we look at our NAV. This is a picture as at the end of September. We expect this NAV to have risen by the end of the year because of the profits we generated in Q4, and because asset values also have moved up slightly between the end of September and the end of December. We were trading at the time at an important discount to NAV, 38%. So yeah, there was a lot of value in our shares. There still is, although our share prices have traded up since. So I think those are the main slides I wanted to present, and I'll pass it over to you for the Q&A session. Okay, so I have one question here, which is regarding our NAV discount. So this is our last slide, and we have this question very often. They are asking why our NAV discount is so big. Well, I don't see company specific reasons which justify this discount. Of course, maybe not being listed in one of the main stock exchanges in which our peers are listed does not help our visibility, but we are working hard in this respect to compensate for this, trying to increase research coverage. And most recently, we also joined the OTCQX market, whereby we hope to increase our visibility with US investors and reach with US investors, and hopefully that will work. We are already seeing some positive signs in that respect, and since we joined the market on the 20th of November, we saw that the average trading volume of our shares increased by 15% relative to the average trading volume in the previous in the 3 months before we joined. So apart from that, I think it's possibly related to the concerns regarding the sustainability of the cycle. The cycle, we are we are still probably in the early stages of this upcycle because of the reasons we covered in the presentation. So it is definitely true that the war in Ukraine has helped the market, and we don't know when this will terminate. It could terminate tomorrow, and we hope so, although it looks unlikely currently that it will terminate soon, unfortunately. But there are other reasons, such as the increase in ton miles linked to the dislocation of refineries, the very slow fleet growth anticipated that we experienced over the last few years and anticipated for the coming years, which of course have also been helping the market. And most recently, we have had also some new factors which have helped the market, such as the congestion in the Panama Canal caused by the reduced daily transits implemented by the Panama Canal authorities because of the low water levels, whereby transits are currently at around 24 vessels per day, whereas they used to be of 38 vessels per day. So vessels that have a regular programs, such as container vessels and some cask carriers, can book well in advance and ensure faster passage through the canal. For us, for companies like ours that operate vessels on a tramp basis, this is much more complicated, and therefore this is impacting quite a lot the product tanker segment. And we expect this to continue impacting the product tanker sector for a few years. Of course, after the dry season ends and the rainy season starts around May next year, this problem might be alleviated for a few months, but it is probably going to we are going to be probably confronted with a similar problem in next year's dry season again. And so that will most likely, this factor is most likely going to be supporting the market for a few years still, until structural measures can be adopted to solve this problem. Most recently, we also have had the disruptions linked to the issues in the Suez Canal, which have been escalating, and whilst we were initially very cautiously continuing to transit through the canal, and we had a few weeks back a few vessels which did cross the canal, and they were escorted by the Italian Navy. We now have adopted the policy of asking, whenever we fix vessels on spot charters, for the option to sail through the Cape of Good Hope. That entails another 10 to 15 days of sailing, and therefore it will contribute to an even tighter market. I think most tanker companies are now starting to adopt similar policies, and we have already seen that the percentage of tankers going through the Suez Canal has dropped by around 25% relative to prior to this conflict. So it is, and this is probably this trend is probably going to be accentuated in the coming weeks, unless hopefully a solution is found. There's a question here which is connected to this, whether this Suez Canal issue is impacting the spot market. It is to a certain extent, but I believe it will even more so in the near future. we are asking when we fix vessels through sale with the option to sail through Cape of Good Hope, of course, for higher freight level to compensate for the additional costs of these longer sailing distances. But this will play out over the next few weeks as the availability of vessels falls, the vessels opening in the different regions of the world fall because of this additional crisis that we are confronting in the coming weeks. Then we will see spot markets go even higher, I believe. So I have another question here, which is linked to the capital allocation, and I believe we covered a bit of that in the presentation. But it is an important factor, and so it's worthwhile maybe going a bit more into detail on this particular topic. Yes, it is true. Yes, we are generating quite a lot of cash, and last year we distributed in April dividends of $22 million, and then we distributed at the end of November an interim dividend of $20 million. We also repurchased shares for 6.5 million euros, worth 6.5 million euros. This year, if the markets continue being as strong as last year, given the even stronger balance sheet we can now count on, we expect to be able to distribute more dividends and reward more our shareholders, potentially also through share buybacks. So of course, yeah, it will depend on how the market develops. And of course, things can change if we were to find particularly attractive investment opportunities that we seek to pursue. But our current, let's say, expectation is that we are going to be distributing more cash to our shareholders in 2023 than we did in 2022. And in terms of capital allocation, not only looking at 24, but also, let's say, 25 and 26. If we were to exercise all the vessels that we currently have on Time Charterin, that would entail investments of around $130 million. All the vessels, I mean, the long-term vessels that we have on Time Charterin, for which we have purchase options. So those 4 vessels, that would entail investments of around $130 million. And another $66 million could potentially be used to reimburse, exercise the options on the vessels that we have on bareboat charter-in. So they're reimbursing those leases. We might make use of some bank debt when exercising these options, but at moderate levels. So that is also an important use of funds for us in the coming years. There's another question here. Do you intend to buy new or older vessels going forward? No, we definitely don't intend to buy older vessels going forward. But we could consider engaging in some sort of fleet renewal, whereby we sell some older vessels to buy younger vessels. That is a possibility. We could entail other type of investments also, but I would say we are not on a fleet expansion mode currently, but more maybe possibly on a fleet renewal. Although we do have still a very young fleet, an average age of 8.5 years. So we are not in a hurry to make new investments. We will only do so if we find the very attractive opportunities. Another question here, will we ever have a US listing? US listing, no, we have now pursued this transaction whereby we joined the OTCQX market, but it's not currently in our plans to pursue a US listing. We will, however, continue working to increase our visibility in the US market and in international markets generally, so hopefully becoming also more appealing to Nordic European investors, despite not being listed in Oslo. And another question here, how will the EU ETS market impact you? I don't think it's going to be a big impact this year. We are already operational in that respect, of course. And we have acquired already our first EUAs. Our estimated needs based on historical trading patterns and how our vessels and the expected contract coverage for our vessels this year is not that significant. Around the 20 to 25,000 allowances will need to be acquired by us this year. Of course, there's a phase-in of these regulations. So in the first year, it's only you have to buy allowances only for 40% of the emissions generated, and then in the second year 70%, and then thereafter 100%. And of course, it's also anticipated that the price of these allowances is going to gradually increase to encourage the energy transition which the regulators would like to see. Most recently, we have actually seen the prices of these allowances come down because of the weak economic industrial activity in Europe. But it is anticipated that they will rise, and that the authorities will adjust the allowances emitted into the market to ensure that outcome. So it will become a more important factor going forward, but for 2024, it's not a very significant factor for us. I don't see other questions here, so I believe we can the presentation. We can consider the presentation closed, and thank you very much for everyone that joined the presentation today, for participating and for your questions. And
Carlos,
thank you so much for organizing.
Carlos, thank you very much. As expected, it has been a very interesting presentation, and you can tell from the many questions we got about the interest of the participants in the company and the sector. I would like to conclude by thanking everybody who joined, and thank you, Carlos. And just to remind everyone that this webinar will soon be available for access upon demand on Capital Link's website at capitallinkwebinars.com, and also on Capital Link's YouTube channel. Thank you very much, and have a wonderful rest of the day.
Thank you. Thank you, Nicholas.
Thank you.